Chart Pattern Example Case Study 74, PENN. A descending triangle accelerates a downtrend to breach a gap fill range and provide an example where chart pattern analysis and technical analysis in general can still be used after price has been adjusted following a split. Similar to other examples, there is a brief pause with neutral to bullish price action after the downtrend line is crossed, but bearish volume does not subside. An old downtrend line marks a valid triple top range that has an expanded lower boundary due to an upswing in early April, widening the gap fill range below it. The old trend line's influence is very apparent with a minor declined double top sharing the same approximate downward trajectory from September to November. After the gap up, there is an aggressive bullish continuation as the horizontal range into 2013 has a noticeable incline. Mid-2013 presents an excellent example of a larger double bottom range that has a less common feature with a gap in the middle of the range, rather than the start or end of the range. The most recent bearish reversal is more accurately from a sharp double top and not an expanded triple or flat top, since the following swing points are too low to be considered as part of the same approximate range in a declined triple top, though a downtrend line from the 3 points is still helpful as a potential double bottom reversal emerges. A volatile downtrend still has price action neatly contained within old ranges that are the site of several smaller patterns. An aggressive incline at new highs originates from a reverse head and shoulders that ends a moderate correction. Here is another example of a gap up that is not immediately filled during an aggressive uptrend. After the old uptrend line is crossed, there is normal neutral to bearish price action that steadily shifts towards an increasingly bearish stance for a likely break of the gap up range. The gap fill area is the wider 2780 to 26 range due to the neckline and shoulder level in close proximity to the gap fill candle. Here is a great example where the mid-20s are a strong support range, having been the site of several bullish patterns. However, it is still breached due to larger bearish context and constant selling volume in the short term. A broader view reveals two head and shoulders reversals in the ongoing downtrend. The first one is a larger variant due to a wider neckline range that factors in the gap up range. There are also pairs of downswings for the shoulders that see the right shoulder also form a moderately large descending triangle to expand the overlapping outline of the patterns. This is a great demonstration where a simple gap range is complicated by the close proximity of additional patterns. Here is a less common case where a relatively small double top produces a large reversal. This is in large part due to bearish conditions from the broader market at the time. The drop is certainly volatile, but the precise long-term influence of the old trend lines and levels is demonstrated by frequent opening and closing prices on these same levels and trend lines. Past price action is much more stable in contrast as swing points often formed in between the various ranges. This could be called a minimal ascending triangle outline, but it is not in the preferred context of a bullish continuation. It is more correct to classify it as a regular bullish reversal, stemming from the large harami. The uptrend line is stable due to the smaller detail of a small gap up fill starting in April. Another reason this is better classified as a normal bullish reversal with ascending triangle features rather than an ascending triangle is seen soon after when the gap downfill resistance leads to an uptrend line adjustment in May. This more accurately marks support for a failed declined double top and the larger uptrend continuation that follows.